Hello everyone, how's it going? In this video, we're going to be talking about AVCT. So the company has certainly been a volatile stock that attracted a huge amount of attention and hope over the past few weeks and months. Lots of speculations and, guesses have been applied to the company since then, and many people are wondering what lies ahead. In today's video, we are going to go take a fresh look at AVCT and see if we should put more capital in the company at this current stage. Before we begin with the video, I'd just like to state a brief disclaimer, which may clarify what this video is about and what it shouldn't be. What is presented is going to be my opinion on things or my interpretation on how things are or will be. They shouldn't be considered as investment advice and should be watched for entertainment purposes for the most part. Might be able to help you for, better decision making, but shouldn't be used as the only material for the decision making. Most of my analysis is done in the immediate term or like just a few days before the video has been uploaded. And the price action might be slightly different from what you see, but it's still useful to be considered as a tool to analyze like the momentum and the trends. Also, the analysis covers the stock as comprehensively as possible, and it will talk about more factors than just the latest news or the price actions. So for instance, we're going to talk about the company's financials, the stock market trends, the long-term perspectives, and the shareholder behaviors. These are going to affect the timing, the quantity, and whether you're going to buy, sell, or hold the stock. Given that most people will be watching my videos for the first time, it's very important for them to consider these factors when deciding whether they should be buying AVCT. So with all that being said, let's begin with today's video. Simply put, AVCT is a cloud-based service provider that wants to profit from the bandwagon of work environment being increasingly virtual and to facilitate the communication between virtual environments. With that being said, the sector does have its potentials, but it also has its pitfalls. Most services in the sector tend to be either free or come with freemium options. People have been conditioned to always seek the cheapest options or to change their work behaviors to accommodate those tools as soon as they learn that those with more capabilities might charge the users. As for corporate clients, their demands are often met with the applications from bigger players already, who may have the means to provide additional support and customizations, with smaller companies that may not be able to scale up the operations or to have the means to provide them. Also, larger corporations provide a layer of stability to the corporate clients, as they may not trust those smaller platforms that they're going to be here to stay. In fact, AVCT right now is a good example of their fears. Who knows what's going to happen to the company once the buyout completes, assuming that a buyout will happen. So this last point is actually a key factor that can explain why AVCT does not have the same kind of success that bigger players have, or the same level of success that it hoped to have during the years it has been operating so far. The decision was taken in summer of 2022 to change the company's strategy to start selling its assets, in part or in totality. So with that being said, the current attraction of AVCT is really the possibility to be sold to a generous buyer who has the money to dole out in exchange of AVCT's client base and technology. This expectation for a large buyout premium justifies the interest that traders have towards AVCT, whether it is reasonable or not. So over the past few weeks, the share price continued to dwindle, as there is no reason for the stock to go higher. The price action is mainly sustained by the likelihood of a satisfactory buyout price within a reasonable time frame. That scenario hasn't occurred so far just yet, and with that when most of the upward momentum AVCT accumulated over the past few weeks, it is obvious that time might be running out for AVCT to profit from the recent uptick in interest. The stock is currently hovering around 80 cents, which is disappointing to say the least, knowing what we know about the company that recently just went through a reverse stock split in order to keep the stock price above $1. A reverse stock split reduces the number of shares while the equity value remains the same, so that each share trades at a higher individual price. The purpose of this action is to prop up the individual share price so that the stock remains above the Nasdaq's requirement to trade above $1 a share. Usually, companies with actual operations make money by working like double shifts to make sure that more people are encouraged to buy their shares, either through PR campaigns or bullish announcements. If the company chooses to use a reverse stock split, though, this suggests that a company is short on time, or it doesn't really have much positive news to announce, but it still needs to do what's needed to remain listed on Nasdaq. In the case of AVCT, it's probably those two reasons that prompted the company to take that route. Overall, the short-term price action does suggest that the additional selling pressure is being exercised on AVCT and that they need to announce something meaningful about the buyout in order to change the current situation. And the long-term price action of AVCT has been under duress as well. The company went public in the worst of the time possible, around March 2020, as the world economies began to shut down, causing a major stock crash. So the crash didn't really last because the share price of many titles climbed back very soon. But AVCT was not that lucky. During the boom years of 2020 and 2021, AVCT gained back some of the initial losses, but it wasn't enough to attract additional traders. And the capital that it managed to raise wasn't able to cover the expenses. Looking back, the company tried to succeed in a highly competitive sector. It wasn't able to sustain its presence and has some very unfavorable market timing against it. So looking ahead, AVCT is now trying to sell itself. Just like the short-term price action, the road ahead largely depends on how well and how soon the buyout will occur, if it occurs at all, and so on. So right now, the online footprint of AVCT is relatively basic, mostly made of the company's PR releases, the occasional mentions from shareholders on the forums, expressing like their hypes and hopes that things are gonna go their way, and the various speculations about like who the buyers might be. What we can gather from all this is that the company is getting as much interest as it should, and that it can be pretty like meager at times. But it's also not unexpected for a small cap company. There is very likely a buyer with whom the negotiations are underway. The fact that no one is officially saying anything or leaking anything may suggest that the terms of the negotiations are not going necessarily in the favor of AVCT, or that they simply want to, prepare a surprise for the shareholders. Personally, I think that it's because the terms are kind of strict, and this is why they don't want to spook the shareholders up. Now, regarding the macroeconomic factors, it's affecting AVCT perhaps more than how it affects other companies, because so far the quantity of money that is flowing into the financial system has been greatly dwindled, which partially is due to the end of the QE, the quantitative easing, the looming recession, and the massive capital flight to other options, aka safer options. And also, the conflicts around the world don't necessarily help. Those factors all affect AVCT in one way or another, but the biggest impact would be on how much capital the buyers might be able to get if they decide to buy the company. Regarding the cash reserves of AVCT, this amount has been decreasing, and the reason why it's kept at a relatively acceptable level is because they've been diluting the equity. The sale of its other business in late 2021 already showed that its financial statements dwindled significantly. It's not impacting the financial positions, but it's certainly going to affect the financial ratios and also how much they can sell the remainder of their business for. In terms of liabilities, there are around $63 million of debt, 22 of which is current, meaning they will mature within a year. This would mean that on top of the operations that are incurring losses, there will be at least $22 million less from the cash reserve in less than a year, suggesting that if the sales takes longer than a year, AVCT might be forced to go through another round of the dilutions. Regarding the profitability, well, the revenue has been decreasing over time, which is likely because of the expectation that those services might be disturbed or cut off once the transaction is completed. So they've sold about half of their expenses, but about 80% of the revenue. Overall, it was a bad transaction. It seems like AVCT was trying to buy itself time or something like that, and that's why they sold it. Meanwhile, there could be another 10 million of operating losses, if not a bit more, outside of the current liabilities, which could trigger further dilution still. So overall, time is definitely ticking and not exactly on the side for the company, which needs to find a buyer to avoid being liquidated, or a complete loss of the shareholders' faith into the corporation. There is about 35% of institutional buyers, which normally suggests long-term trust into the company's operations and potentials, but in this case, I do tend to think that it just means that the institutional buyers are a bit optimistic regarding a generous buyout from industry giants such as Microsoft, whose name has been name dropped a few times. Given that AVCT continues the sell-off, I do believe that retail traders are jumping on the ship in great numbers, but the institutional buyers probably remain in place. Not because they're more optimistic, but just because their position size allows them to be more patient and to be more stoic about the price action. So regarding the potential short squeeze, I would say that, okay, first of all, a quick definition of what a short squeeze is. It's about retail people piling in and drive the stock price up, which forces those with short positions to redeem them. And given that they want to maximize their gains and minimize their financial costs, the longer it drags on, the less gains they're going to potentially make. So currently about 800,000 shares are shorted for AVCT, which is significant, but it does only count for about 7% of the volume, which may not be that much in the grand scheme of things. So this is why I think that the short positions are a major reason why the shares are down, but it's not enough for an actual squeeze. So which kind of investor would be good for AVCT? In fact, it's not necessarily investor, it's going to be traders. It's definitely going to be those who are used of trading penny stocks. They're willing to take on risks. They're comfy with significant downward pressure. They're very good with trade disciplines. And they have a diversified portfolio that can allow them to take the hit on this stock. So my recommendation is to have a position in AVCT if you think that the takeover or the buyout is going to happen. Meanwhile, we also need to see at least a clear sign that the sell-off has ended and that the price will even resume being on either the sideways or upward. Because otherwise, it's just going to be better to wait for another few days for a better entry point. It would be best to wait indeed for the support to be able to sustain itself for at least another 2 to 3 days in the week to come. So regarding AVCT, my personal recommendation for exposure would be between 0.5 and 1% of the portfolio. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.